S1. Hook. Most Australians who invest in shares, or who are thinking about it, are leaving money on the table every single year. Not because they are doing anything wrong, not because they missed some obscure tax loophole, but because the Australian tax system has a built-in mechanism that can literally result in the Australian Tax Office sending you a cash payment. It is called franking credits. And if you own, or plan to own, Australian shares, understanding how this works is not optional. It is one of the most powerful features of the Australian investment system. In this video, I am going to break down exactly what franking credits are, how the refund mechanism works, who qualifies for it, a rule that trips up some investors, and the honest answer to whether this is actually going to last. Call to action. Before we go any further, this video is for general educational purposes only. Nothing here is financial advice. I am not a financial advisor, and this is not a recommendation to buy any investment product or share. Always speak with a registered financial advisor or tax agent about your own situation. Let us start with the basics. S2. What is a franking credit? When an Australian company makes a profit, it pays corporate tax on that profit. As of 2026, the standard corporate tax rate in Australia is 30% for large companies. So far, so straightforward. Now, when that company pays a dividend to its shareholders, meaning it distributes some of those after-tax profits to the people who own shares, there is a question of fairness. The company has already paid 30% tax on that money. If you then pay income tax on the dividend as well, you are effectively being taxed twice on the same dollars. Australia's dividend imputation system was designed to fix that. Here is how it works. When a company pays a dividend out of profits it has already paid tax on, it can attach a franking credit to that dividend. The franking credit represents the tax the company already paid on your behalf. When you receive the dividend, you report both the cash dividend and the franking credit as income. But then, and this is the key part, you get a tax offset equal to the franking credit. So the prepaid company tax is credited against your personal tax bill. A dividend can be fully franked, meaning the full 30% corporate tax rate has been applied to those profits. Or it can be partially franked, meaning only part of the profits were taxed at the full rate. Some dividends are unfranked entirely, typically when the company sourced profits from overseas earnings. Call to action. The ATO's website at ato.gov.au is the definitive source for all of this, and I will put that link in the description. S3. The refundability mechanic. Now here is where it gets genuinely interesting, and this is the part that surprises most people. Under Australian tax law, franking credits are refundable. That means if your franking credits exceed your total tax liability in a given year, the ATO refunds the difference to you in cash. Let me give you a concrete example. Note that these numbers are illustrative. They are designed to show the mechanism clearly, not to represent any real investment. Imagine you receive a fully franked dividend of $1,000. The franking credit attached to that dividend is roughly $430. That represents the 30% corporate tax the company already paid on that profit. When you do your tax return, you include the dividend and the franking credit as income. Your total taxable dividend income is around $1,430. Now let us say your income tax liability on that amount, based on your marginal rate and your overall tax position, works out to $130. Your franking credit of $430 exceeds your tax liability of $130 by $300. The ATO refunds that $300 to you as a cash payment. That is not a tax deduction. It is not a discount. It is a direct cash refund. This is why Australian shares with high franking ratios can generate a meaningfully higher after-tax return than the headline dividend yield might suggest, particularly for investors in lower income tax brackets, those in pension phase, or those with significant deductions. As of 2026, refundable franking credits remain current law in Australia. As with all tax legislation, this can change with future budgets or policy decisions. I would encourage you to check ato.gov.au for the most current position before making any investment decisions. Call to action. The ATO has detailed guidance on franking credits and tax offsets under their individual investor pages. I will link directly to that in the description. S4. The 4-5 DAY holding rule. Before you think you can simply buy shares the day before a dividend, collect the credits, and sell immediately, there is a rule you need to know about. The ATO requires that you hold shares for at least 45 days, not counting the purchase day or the sale day, in order to claim the associated franking credits. This is a statutory rule under the Income Tax Assessment Act. There is, however, an important exception for most retail investors. If your total franking credits from a particular company are $5,000 or less in a given year, you are exempt from the 45-day rule. The ATO calls this the small shareholder exemption. Call to action. For the majority of Australians investing in a diversified share portfolio, particularly those just starting out, you are unlikely to hold enough of a single company's shares to exceed that $5,000 threshold. But if you are a more substantial investor, or if you are actively trading around dividend dates, the 45-day rule is something your tax agent should review with you specifically. The rule exists to prevent what the ATO calls franking credit trading. Essentially, purchasing shares purely to capture credits with no genuine investment intent. Your tax agent can confirm whether the 45-day rule applies to your individual situation. S5. High franking stock examples now. Which Australian companies actually pay franked dividends? Many of Australia's largest listed companies have historically distributed fully or substantially franked dividends. I want to be clear. I am going to name some companies as examples to illustrate the concept. This is not a recommendation to buy any of these shares. Always do your own research and speak with a financial advisor before making any investment decision. Call to action. For illustration only, companies like Commonwealth Bank of Australia, BHP Group, Wesfarmers, and Telstra have historically paid fully franked dividends to shareholders. This is for illustration only, not a recommendation to buy these shares. Past dividend history is not a guarantee of future dividends or franking levels. The ASX website at asx.com.au has a dividend history tool that lets you look up the franking status of any listed company's dividend record. That is a useful starting point for your own research. If you are building a portfolio with an eye on franked dividends, which is what our next video covers in detail, the key is understanding how the overall franking yield interacts with your personal tax rate. And that is a conversation worth having with a registered tax agent or financial advisor. S6. SMSFs in pension phase. There is one specific situation where franking credits become extraordinarily powerful, and it is worth covering briefly. If you have a self-managed superannuation fund, an SMSF, that is in pension phase, the fund pays 0% tax on its income and capital gains. The practical consequence of this is that every franking credit the SMSF receives is fully refundable in its entirety, because there is no tax liability to offset against a fund that receives $10,000 worth of fully franked dividends can receive the entire associated franking credit as a cash refund from the ATO. If you have an SMSF in pension phase, this is how franking credits work for your fund under current law. the specifics of how to account for and claim those credits correctly, and whether this makes sense for your fund's strategy, is something your accountant and SMSF administrator will handle. This is general information only, not advice about setting up, managing, or changing your SMSF strategy. S7. Is this going away? I am going to address this directly because it comes up every time this topic is discussed. In the lead up to the 2019 federal election, the Australian Labor Party proposed eliminating the cash refundability of franking credits. That is, the ATO would no longer send you a refund check if your credits exceeded your tax liability. The proposal was controversial, and Labor lost that election. The Albanese government, which took office in 2022, has not revived that policy. As of 2026, refundable franking credits remain current law in Australia. I am not going to tell you this will never change. That would be a prediction about future government policy. And I am not going to make that call. What I can tell you is the current law. And I would encourage you to check ato.gov.au for the most up-to-date position. Call to action. S7B. CTA, affiliate. If you are looking at getting started with Australian shares, or you want to start receiving those franked dividends yourself, you will need a brokerage account. Call to action. One platform worth looking at for dividend-focused investing is Perler. It is designed for long-term, buy-and-hold investors, which aligns well with the dividend reinvestment approach we cover in the next video. Link in the description. S8. Close plus full disclaimer. So, to bring it all together, franking credits are a refund of tax the company already paid on your behalf. If your credits exceed your tax liability, the ATO refunds the difference in cash. The 45-day holding rule exists, but most retail investors are exempt. And as of 2026, this system remains current law. Call to action. If you want to go deeper on how to actually build a portfolio around Australian dividend investing, and what to look for beyond just the franking rate, our next video covers exactly that. I will put a link in the description. This video is for general educational purposes only. Nothing in this video constitutes financial advice or a recommendation to buy any financial product. I am not a registered financial advisor, and this video does not take into account your personal financial situation. Please consult a registered tax agent or financial advisor for advice specific to your circumstances. Sources include the Australian Taxation Office at ato.gov.au. Call to action. If you found this useful, a like on the video helps more Australians find it, and there is a subscribe button if you want to be here for the next one.